Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Welcome to another edition of the Cambridge podcast. Glad that you're all here and listening to us. Today I'm going to be talking about executive compensation and executive benefits. Over the past 28 years, I have done a tremendous amount of work with small business owners throughout the United States. And most of them share some of the same issues and concerns, and obviously the goals and objectives that they would want for their companies and also for their employees. You know, for the majority of small business owners, once they start doing fairly well, they want to be able to provide certain employee benefits to their employees, obviously to maintain loyalty in the employment agreement and so forth. So usually what many of these employers do is they provide some kind of a qualified plan. And what I mean by a qualified plan are those plans that fall under the rules and engagement of RISA and also government entities and so forth, like 401ks, SEPs. Some of them do fall under RISA, some of them don't. You're talking about deferred compensation programs if you work in the public sector, 403B arrangements if you work in the public sector. In other words, what these plans do, simple IRAs, what these plans do is allow employees to put money into a plan for retirement, have that money go in on a pre-tax basis, have the money grow tax deferred. And in addition to that, they also have the ability to generate some matching contributions from the employers. So it's a fairly decent benefit for the employees, and it's something that many employers are looking forward to do on a regular basis. Now, one of the challenges that employers have is that when you do those types of qualified plans, you must be able to include everyone that fits a certain profile or that has, a given number of hours worked throughout the year and so forth. And obviously age, becomes an issue as well. But for the vast majority of employers that we deal with, they must provide these benefits to everyone straight across the aisle. It doesn't matter whether it's a good employee, an average employee, or a really bad employee. You must be able to provide those benefits without any type of discrimination along those lines. Now, today's podcast is going to be on executive benefits. And these will be primarily your non-qualified executive benefits. One of the major leverages that employers have is that through non-qualified executive benefits, if they do it the right way, they do have the ability to discriminate. They can pick and choose the employees that they want to provide these benefits for. And that's a good thing from a business standpoint because, the business owner has the leverage and the ability to make certain that he is rewarding those employees that deserve to be rewarded. Now, many times, they do a combination of both. They provide your traditional qualified plans, as we have talked about, to all the rank and file employees and their executives and so forth. And then they carve out and set up a separate type of plan that would be non-qualified in nature that gives the employer a lot more leverage. Now, along those lines, we have many of them available. Today, we're going to talk about your traditional Section 162 executive bonus program. Except that in a traditional Section 162, the owner of the business has no golden handcuffs, cannot tie that employee to the corporation for many years. And many times the employer says, well, if I'm already providing some kind of a qualified plan to all my employees across the board. If I'm going to entertain doing something on a non-qualified basis, I want to make certain that I can get something in return. Obviously, business owners listen to a very famous radio station, which is WIFM, What's in it for me? And they want to make certain that they can protect themselves in the case that those key employees were to leave the firm. And that's where we come in. Based on the type of work that we do and the expertise that we have in our ability to create and formulate non-qualified agreements on behalf of these employers whereby they can have their cake and eat it too. So today we're going to talk a little bit about a golden executive bonus arrangement, or as we call it, a GEBA arrangement. And the challenge is that, employers commonly award cash bonuses to their employees, usually at the end of the year, because obviously the employees play a key role in growing the business. Now, often these bonuses are spent shortly thereafter, and until these employees get a second bonus or an additional bonus down the line, then it's out of sight, out of mind. So we feel that there's a better solution for the business owner and also for the employee from a business perspective, because instead of providing executive bonuses as a cash payment, the employer can consider leveraging them into a long-term financial tool for their key employees and a potential benefit for their families as well. So whenever an employer embarks on an executive bonus arrangement, not only is he thinking about the well-being of the company to make certain that the business owners, he or she, or the combination of business owners can maintain loyalty at the corporate level, but they're also thinking about the well-being of that employee, that executive, that key employee, and their families as well. So obviously, those are things that are done on a regular basis with many of those issues and concerns in mind. Now, for many of these executive bonus arrangements, cash value life insurance is, in fact, the ideal product in order to formulate the plan. And the reason for that is that cash value life insurance is a long-term financial tool that provides a number of benefits during the key employee's entire life. So what I'm going to do is I'm going to kind of break them down for you so you can get a feel as to how to formulate something like this if you happen to be a small business owner. Now, during the working years, the employee gets a tremendous benefit out of it because there's death benefit protection. Therefore, in case of death or premature death, it does provide funds to help ensure that the employee's family is cared for financially. And that is something that is very critical because many of these plans that we do on behalf of these employers, when we have the one-on-one with each and every one of those executives that are going to be earmarked for this type of benefit, that's a major consideration for them. So they feel very comfortable and very happy that the employer is thinking along those lines. Now, because we're talking with permanent life insurance, you have a death benefit side, and you also have a cash value side of the equation as well. So the cash value does provide a source of funds that can be used during the key employee's lifetime, such as, many times it could be as a buy-sell where the employee may be interested in purchasing the business from the business owner because it's a small business. Perhaps that executive, that employee has been in the company for many, many years. They understand the workings of the company. They know the company inside and out. The business owner may not have the ability to pass that business on to a family member because he or she may not have one that is readily available to take over the business, or he or she does not have anyone in the family unit that may be interested in taking over the business. So it does provide certain benefits as well. Now, after retirement, the death benefit protection obviously can be used for estate planning needs. Again, if that executive or employee were to die prematurely right after retirement or years along those lines, the death benefit protection is going to provide tax-free death benefit to the surviving spouse and family. So the consideration of family protection is very critical from a business standpoint. Now, because it is a permanent life insurance contract and it has cash values, by the time this employee or executive retires, he or she will be able to maximize and receive supplemental retirement income on a tax-preferred basis. Now, remember, as I have covered many a times, there are only 3 vehicles under the IRS code that receive total tax-free distribution, and those are your Roth 401ks, your Roth IRAs, and your life insurance contracts. So obviously having something like this from a business perspective is something that is very enticing, for most employees that are receiving cash bonuses on a regular basis, and now have the ability to leverage those cash bonuses, because now they're going to be paid toward the creation of an executive bonus program using life insurance. Now, how does a GEBA or Golden Executive Bonus program, with life insurance works? Well, in this situation, if you happen to be a business owner, you and your key employee will enter into an employment agreement. Now, these employment agreements are normally drafted by a licensed attorney, and it specifies the bonus vesting schedule and other provisions. This is one of the most critical aspects of GEBA plans, because if I'm the business owner and I have a key executive that I want to provide some additional benefits to above and beyond what I may do for everyone else, and by the same token I want to make certain that I can leverage that additional bonus, I want to make certain that employee is going to remain in my firm for years to come. So as I draft the agreement with the attorneys, I want to make certain that we can put a vesting schedule on that agreement, because I want to make certain that employee is going to be with me for the next 3, 4, 5, 7 years, or whatever the time may be that we agree upon as far as the vesting schedule. So it does give the business owner the leveraging and the golden handcuffs to make certain that they're going to be able to retain that key employee for many years to come. Now, obviously, as a business owner, you will pay a tax-deductible bonus to the employee, meaning that as an employer, when you make that contribution, that additional bonus contribution to that employee, it will be a tax-deductible contribution and deduction for you as a business owner. So that's a good thing, because you're going to be able to claim that deduction every year when you make that bonus contribution. Now, the key employee, because the employer deducted the premium on the contract, the key employee will pay the income tax on the bonus amount. So if the bonus is $10,000 on an annual basis, and the employee happens to be in the 25% tax bracket, well, the employee will pay $2,500 in federal income taxes on that $10,000 bonus. Now, the employer does have the ability to choose to pay the income taxes on behalf of that employee as well, with an additional bonus, and that's what we call a double bonus arrangement. So the employer will give not only the $10,000, but will give additional money not only to pay the $10,000 of premium into the contract, but also to leave enough money outside of that premium payment for the employee to cover his or her tax liability at the end of the year. But even if that is not provided, how would you like to pay 25 cents on the dollar if you were an employee? If you receive a $10,000 bonus that is going to provide an executive benefits benefit not only for you today, but also in the future and after retirement. And by the same token, it's going to protect your family. And your only cost would be the tax on that bonus, or $2,500. Obviously, as an executive or an employee, I would want to do that every single day of the week. Now, the employee then takes out a personal life insurance policy and names a beneficiary. When we do these for employers, normally we may have 2 or 3 or 4 different employees that are going to be part of this program. So we at Cambridge sit down with each and every one of these employees, and we designed a contract that is based on the goals and objectives of that individual employee. So we do have the ability to split the bonuses and split the coverages depending on what that specific employee is looking forward to from a business perspective. Now, the policy instructions will accompany the policy. And what the policy instructions agreement does is the one that was drafted with the employment agreement through the attorney. And then obviously it restricts the employee's access to the cash values as outlined in the employment agreement. So if I set up a 5-year vesting schedule with one of my employees, and I'm making $10,000 of contributions for all of those years, or for as long as that employee remains in my company, then I want to make certain that for those first 5 years of the vesting schedule that I do have as an employer control of the cash value. Now, once a vesting schedule has been formulated and completed, then the employee will have access to the cash values as well. Now, usually the bonus is used to pay a premium on a life insurance contract, and we do have the ability to use a number of different carriers for that basis, but the key is to make certain that we find a carrier that is able to provide not only a strong contract, but also a guaranteed contract under the business that we're trying to ascertain. Now, since the employee will own the policy, he or she may use the policy's cash value on a tax-preferred basis, and that's normally done after the completion or execution of the vesting agreement based on the vesting years that were put together when the agreement was originally drafted. Now, if the employee dies, obviously the death benefit is payable to the beneficiary on a federal income tax free basis. So I think one of the key questions is, why use a golden executive bonus strategy agreement as opposed to something else? And I'll walk you through the company benefits and also through the key employee benefits. So if I'm the business owner, the company benefits for me is, number one, is that it is fairly simple. It's a straightforward implementation and administration. It's reported to the IRS as wages, so I don't have to create any additional paperwork along those lines. It's quite cost effective. It is deductible as a business expense. So when I do give that $10,000 bonus, as I did in my example, I'm going to be able to deduct as a business owner. I'm going to be able to deduct the $10,000 bonus as an employee benefit, which I can do and will do in the year in which I do that bonus. It's minimal cost to administer. So it does not require the filing of 5,500, which are tax returns, for qualified plans, as is done on the other side of the ledger. It is selective, and that's a critical aspect of these executive bonus, because I can pick and choose to reward certain highly compensated employees or management, and I can discriminate. I don't have to do it for everyone. I can pick and choose who I'm going to do it for, and also I can pick and choose the amounts of contribution that I'm going to be making for each and every one of these executives. So I could have someone that is in middle management, someone that is upper management, and I can give a bonus to someone in middle management of, let's say, $5,000, and give a bonus to someone in top management of $10,000, $15,000, $20,000 bonus. So I, as a business owner, have the ability to make that decision. There's no IRS qualifications, so you don't have to abide for any of those rules that govern qualified plans. There's no participation or eligibility rules as in qualified plans. It's quite flexible. There are no required plan provisions. It's customizable for each key employee, as I stated earlier. You may have an employee that is not married, and he or she is not really interested in providing a death benefit to anyone, but obviously does have a death benefit, but they do want the ability to grow as much cash value as possible. So we would set up a plan where the majority of the money and the contribution is going toward the growth of the cash value with minimum death benefit protection. On the other side, if you're married and you have a family and you love your family, you may want a higher death benefit in the plan because you want to make certain that if you have a premature death, that your family is well taken care of. So we do have the ability to do either one, and sometimes we do a combination of both, which also happens quite often. The plan can be terminated at any time, and it also, because of the golden handcuffs arrangement, and because of the fact that you're providing a bonus above and beyond what the employer needs to do based on employment guidelines, golden handcuffs provided through the employment agreement and policy instructions does encourage loyalty on behalf of those employees as well. So for the company, it's a win-win because you're providing a benefit to an employee, to a key executive, above and beyond what you should have done or could have done if you didn't want to do this. And you're also providing family protection along with retirement and income protection and access to cash value on a tax-preferred basis. And the bonus is not one that you're going to pay today and it's going to be spent tomorrow. The bonus is going to be there, and it's going to provide a benefit that is going to last a lifetime. So as far as the company is concerned, it's a great thing for them if they can afford to do this. Now, as far as the key employee benefits, obviously there are many of them. First, we start with the death benefit protection. Protection is there for premature death. Also, income replacement. So if I don't make it to work tomorrow morning, I happen to be an employee, and my employer provided me with an executive bonus that has a death benefit protection. If I'm no longer able because I had a premature death, my family is going to be protected because they're going to be receiving a federal income tax-free death benefit from the policy proceeds. Now, as an employee, it is a flexible financial tool. So the cash value may serve as an opportunity to do different things, as an opportunity reserve. It's an asset that's available to help fund future investment opportunities or purchases, once the employment obligations are met through the vesting schedule and agreement. So the employee is going to have a tremendous amount of flexibility, once the employment agreement has been completed and conformed with. The employee, obviously, upon retirement, does have the ability to use the cash values as a supplementary retirement plan, and if he or she does it the right way, they're not going to have to pay any federal income taxes on that distribution, and that distribution is going to be tax preferred, and the distribution is not going to have a negative impact on provisional income calculations for Social Security benefits. Now, there's portability as well. So once the employment obligations are met, the employee may choose to continue paying the premiums on the policy or exercise any rights under the policy provisions. If the employee were to leave the company after the executive vesting agreement was terminated, then the employee can take that contract with them. They don't need to requalify because they own the contract personally, and they have a tremendous vehicle available that they can exercise all of its benefits at some point in time in the future. Obviously, in these contracts, there's a tremendous amount of tax benefits, not only for the employer, but also for the employee. Now, there's tax deferred growth of the policy cash value. So the money that goes into the contract is after tax, because you as an employee paid the taxes on the contract, or maybe it was a double bonus. But again, the money goes in after tax. The money grows tax deferred. And then you also have tax preferred retirement income. Through obviously the use of policy loans and withdrawals. So we're not going to get into how to get that done, but it's fairly simple to make certain that when you start taking retirement distribution out of a contract like this, and that you don't have to pay federal income taxes. One of the cases that we did not too long ago for a 50-year-old executive, by the time the 50-year-old executive was going to be 65 years of age, or 15 years down the line, this employee was going to be able to start taking at the age of 66, which is the year after retirement. They were going to be able to start taking $72,600 a year tax-free for the next 20 years. So that's a tremendous benefit. If you happen to be in the 25-30% tax bracket, in order for you to net $72,000 and change a year, you must take at least $100,000 and pay the taxes on that, and then net the $72,000. So this is a great tool from a taxable perspective. Now, obviously, there's always an income tax free death benefit. So those are things that are very critical, especially from a family protection standpoint. Now, some of the company considerations that need to be taken into view is that, the company does not receive the policy's death benefit proceeds should the employee die. Why? Because the employee is the one that owns the policy. So the employee owns a policy, and they get to pick and choose who the beneficiary of the contracts are from a business perspective. Now, some of the key employee considerations, the bonus is taxable income and will increase the employee's current income taxes. So, if you're making $80,000 a year and you get a $10,000 executive bonus, now your income will go up to $90,000. Obviously, if the employer wishes to double bonus the tax on those $10,000, then it's pretty much a wash. But you have to understand that it will increase the employee's tax liability because it's increasing the employee's income. Now, if you're an employee or an executive under this plan, and you happen to be less, healthy, you may have a little bit more challenging time in order to get approved, or you may have to pay a higher premium on the cost of insurance because of an additional rating based on your health condition. So, but that's something that you deal with when you get there. And by the same token, even if I'm not preferred or even if I'm not standard, if the company's willing to enter into an agreement where they're going to provide an executive bonus, and then I'm going to be able to buy life insurance to protect my family just by paying the tax on that bonus, then it means that even if I'm not as healthy as I could have been, it is still a tremendous employee benefits for me as an employee or executive. Now, the employee also needs to consider that he or she will have no access to the policy cash values, until the employment obligations are met. And then, upon retirement, they need to understand that any policy loans or withdrawals, will reduce the net amount at risk or the net death benefit that would be payable to the survivors upon the demise of the employee. And then obviously to continue the coverage, employee may need to increase, premium payments, depending on policy experience. Usually that doesn't happen in our situation because we're using contracts that are guaranteed from a actuarial standpoint when we put these together for our clients. So with that being said, having an executive bonus program, as an employer, it's a critical aspect of providing executive benefits. And they're really, really good in the sense that the small business owners in the United States, and I deal with many of them along those lines, that create these bonus arrangements, do so primarily to do something for their employees above and beyond what somebody else may do. But by the same token, they do it to protect that employee from leaving, or to protect the corporation from that employee's loss if he or she were not around. So obviously those are things that are very critical. And with that, one of the things that I always try to tell all of you when we do this podcast is that our number one goal at Cambridge is to kind of change the way that you see things, because when you do change the way that you see things, the things that you see change. So again, whenever you are, whether you're an executive employee or you're a key employee in a business format, or you happen to be a business owner, and you feel that this could be an interesting topic, you do have the right and the ability to bring this issue up to your employer or to the business owner. And if you happen to be a business owner and you want to, find out what is the best way to put these types of plans together on behalf of your key executives in the company and your key employees, please feel free to reach out to us at any point in time. So with that being said, I want to wish you all a great day, and we'll talk again next week. Thank you, and have a wonderful day.